Silver isn't up big right now. Silver is stressed, and the stress is starting to dictate the price. The headline crowd will tell you this is just another fear spike, another hot tape, another metal doing what metals do when the world gets weird. But the market S plumbing is saying something more uncomfortable. The real signal is in T, in the quote you see on a screen. It's in the pressure hiding underneath it. And over the next 72 hours, that pressure is either going to vent cleanly, or at S going to force a bigger move that a lot of people are not positioned for. Later in this video, I'm going to give you the exact checklist I am watching, what level matters, what would confirm the squeeze style continuation, what would weaken it, and the one metric that turns this from price talk into a real setup. And that's where the real pressure starts. Because here's the first thing you have to accept if you want to trade or invest around silver without getting emotionally mugged. Spot is not the whole truth. Spot is the billboard. It's the headline. It is the number that makes you feel smart when it's green and stupid when it has red. But spot is usually the last place stress shows up, not the first. Stress shows up in the places where real participants have to make real decisions, where a refiner has to source feedstock, where a fabricator has to lock supply, where a dealer has to hedge inventory, where a fund has to roll futures, where an options book has to hedge delta, where someone who promised delivery has to decide whether they can actually source the ounces. That's why silver can look fine right up until it isn't, because the quote can lie for longer than your patience can survive, while the spreads and the structure tell the truth the entire time. But that's not the part that matters. The part that matters is what the structure forces people to do when the tape gets thin. So let's put some real-world context under this, right now, this week. Silver has just printed levels that would have sounded ridiculous not long ago, ripping through prior references and hitting fresh records intraday before pulling and snapping again. That kind of move doesn't happen in a vacuum. It usually needs a cocktail, macro stress that makes non-yielding assets attractive, liquidity that's thinner than people think, and positioning that's wrong-footed. The obvious driver is the fear bid, concerns about policy, geopolitics, institutional credibility, and the kind of debasement trade to psychology where people don't want to hold promises, they want to hold things. But if you stop there, you're going to miss what actually drives the next phase. Because the next phase isn't powered by fear, it's powered by mechanics. And mechanics don't care if you feel brave. They don't care if you feel skeptical. They care about constraints. Now zoom in on the time window, the next 72 hours. This is not an arbitrary countdown meant to hype you up. This is a calendar problem. This week is one of those moments where the commodity complex gets forced flows, rebalancing, rolling, hedging resets, and the kind of mechanical repositioning that has nothing to do with opinions and everything to do with mandates. That matters because silver is not a deep, forgiving market when it's stressed. It is a market that can look liquid until liquidity suddenly becomes an illusion. When big passive or systematic flows collide with tight physical conditions and aggressive hedging, the order book doesn't negotiate. It gaps. And if you've been around commodities long enough, you know the rule. The most violent moves often happen when the market is doing something boring under the surface. The next detail is what flips the whole setup. Here's the hidden detail that most people miss because they re-addicted to narratives. Forced selling can set up the next leg higher. That sounds backwards, so listen carefully. In these earlier windows, there are participants who have to reduce exposure, roll exposure, or rebalance exposure, whether they want to or not. They're not choosing to sell because they hate silver. They're executing a process. In a calm market, that's just flow. In a stressed market, that flow can drain liquidity right at the moment when other participants are scrambling for hedges and physical. When liquidity gets drained, price becomes jumpier. Spreads widen. Dealers back away. Market makers widen their quotes because they don't trust the tape. And the paradox is, the more the tape gets jumpy, the more hedging demand can increase, which can create forced buying through options and futures dynamics. So the market can dip on a mechanical sell, and that dip becomes the spark that lights the bigger move, because it triggers hedging feedback and it triggers the panic of being underallocated. But that's not the part that matters. The part that matters is whether the stress shows up as a clean pullback or as a signal that someone can't source metal without paying up. And you can see the street symptoms when you know what you're looking at. Symptom number one is volatility that doesn't behave like random emotion. It behaves like location risk. It behaves like the market admitting the metal is not where it needs to be. When a commodity is plentiful and easily moved, price action is usually smoother, mean reversion is friendlier, and dips are bought in a more orderly way. When a commodity is constrained, by refining capacity, by logistics, by vault availability, by competing claims, price action gets sharp. It whips, it rips. If it loses that zone and stays below it, the market is telling you the breakout was more fragile. That's your first anchor, but that's not the part that matters. The part that matters is whether the structural signals agree. Second proof point, the curve and front spreads. Even if you don't trade spreads directly, they are the lie detector. If front spreads stay firm while spot chops, it suggests near-term demand for immediacy. If front spreads soften dramatically, it suggests the market is exhaling, the panic premium is fading, and the move might need more time. And this is where traders get trapped. They focus on the headline candle, while the curve quietly changes character. Watch the curve, not the commentary. Because if this one level breaks, the math changes. When the curve relaxes, the forced urgency relaxes too. Third proof point, institutional flow channels, especially the easy button for retail and allocators. When investors rush into silver via trusts and exchange-traded products, the ecosystem has to source metal or reroute bars. Sometimes that happens smoothly. Sometimes it exposes tightness. The key is not to worship flow as a religion. The key is to recognize what it does to the system. It pulls metal into a structure and reduces floating supply elsewhere. That can tighten the market even if total inventory doesn't collapse. And when the market is already stressed, that tightening can matter fast. But that's not the part that matters. The part that matters is the interaction. Flows plus tight curve plus thin liquidity equals price gaps. Fourth proof point, on-the-ground premiums and availability. You don't need to turn this into a viral, there's no silver anywhere story. You just need to track whether retail and regional premiums are rising, whether delivery times are stretching, whether certain bar types are commanding unusual premiums, and whether the cheap sources are getting cleaned out. Those are real-world symptoms that the paper market can ignore only until someone needs physical. When premiums rise while futures chop, it's telling you that physical demand is not being fully satisfied at the headline price. That is attention. Intention is fuel. Fifth proof point, cross-market comparison. Silver doesn't trade in isolation. If gold is ripping on safe haven demand and currency confidence stress, silver often gets dragged with it, but silver tends to exaggerate. It's thinner, it's more volatile. It has industrial DNA that makes it sensitive to supply chain shifts. So when gold runs and silver begins to outperform, it can be signaling that the market is repricing not just fear, but the structure of availability and the leverage in positioning. But that's not the part that matters. The part that matters is who gets forced to act when silver starts moving like that. Now let's talk about positioning in the margin spiral without sensationalism. When price moves fast, risk systems tighten. Brokers raise margin. Volatility models reprice. Some participants reduce exposure, not because they changed their mind, but because their risk limits changed. That's how you get forced selling in the middle of an uptrend. And that's also how you get forced buying when shorts are trapped. Because short positions are not just bets. They're obligations. They're promises to deliver exposure and, in some cases, deliver metal. If price keeps moving against them and the curve stays tight, rolling becomes more expensive, financing becomes more expensive, and the temptation to cover grows. Then you get reflexivity. Covering pushes price higher, which pressures other shorts, which triggers more covering. That's not conspiracy, that's math. And now we need to bring in options, because this is where the market can turn from strong into violent. If a large amount of call open interest sits near certain strikes, especially near round number psychological zones, market makers who are short, those calls often hedge by buying futures or spot proxies as price rises. That's delta hedging. In a certain regime, if price climbs into those strikes and keeps going, the hedging demand increases. That can create a feedback loop where rising price forces more hedging buying, which pushes price higher, which forces more hedging buying. That's how gamma can amplify moves. And when liquidity is thin, amplification doesn't look like a smooth ramp. It looks like air pockets. It looks like gaps. It looks like the market skipping price levels like stones across water. But that's not the part that matters. The part that matters is the calendar. Because hedging intensity changes as expiries approach, rolls occur, and liquidity shifts. So here, as your why now in plain language, this week compresses multiple forces into a short window. You have macro uncertainty boosting demand for hard assets. You have a market that has already moved fast, meaning risk systems are sensitive and positioning is fragile. You have calendar-driven activity, rolls, rebalances, expiries, making flows less discretionary and more mechanical. And you have a metal whose physical pipeline cannot instantly expand to meet sudden urgency. Mining output doesn't double because the chart looks bullish. Refining capacity doesn't teleport. Logistics doesn't become frictionless. Recycling supply doesn't surge overnight without price creating incentives over time. So the market's adjustment mechanism is price. Price must do the work of rationing. And when price has to do rationing in a thin market, it tends to overshoot. Now I want to be very clear about something, because trust matters, and so does credibility. None of this means silver must go up tomorrow. This is not a guaranteed return fairy tale. This is a pressure map. Pressure can release in two ways. It can release through time. Chop, consolidation, a controlled pullback that lets the market rebuild liquidity and digest positioning. Or it can release through price, continuation, gaps, and the kind of squeeze behavior where even people who agree with the thesis get shaken out because the swings are too violent. That distinction is your psychology shield, because the market will try to steal your position by making you emotionally reactive. And that's where the real pressure starts. Let's build that psychology shield right now, because if you don't, the next 72 hours will manipulate you. Here are the two emotional traps that silver loves to set. Trap 1 is the panic dump after a sudden downdraft. You see a sharp red candle, the news suddenly sounds less bullish. People start talking about top, and your brain screams, I need to protect myself. But in a stressed market, sharp downdrafts are often liquidity events, not thesis invalidations. They are the market clearing weak hands, harvesting stops, and forcing de-risking. Trap 2 is the FOMO buy after a gap higher. You see silver ripping, you feel late, you feel embarrassed for not being in, and you chase right when the move is most likely to snap back. The way you avoid both traps is simple and brutally unsexy. You define your time horizon and your invalidation before the tape goes crazy, not during, before. Because once volatility hits, you're not thinking, you're reacting. So what's the plan? It starts with understanding trend signal versus noise. Trend signal is structural. Higher highs with supportive structure, firm front spreads, persistent demand, and pullbacks that get bought in zones that make sense. Noise is emotional. Intraday spikes, rumor-driven swings, and chaotic whips that don't change the underlying structure. You can't control noise, you can control your sizing and your process. And that's why the next 72 hours matter. They're likely to be noisy. The question is whether the noise occurs above the structural zone that matters. Because if it does, the market is telling you the trend is intact. If it doesn't, the market is telling you the move needs more digestion. Now let's talk levels in a way that respects reality and avoids fake precision. When silver prints record highs, say it spikes into the mid-80s region and then snaps back, the exact tick is less important than the zones. Zone 1 is the breakout launch area, where the move accelerated from fast to faster. In recent action, that's been the high 70s to low 80s neighborhood, depending on the reference you're watching. Zone 2 is the prior base, where the month began, roughly the low 70s region, where the market was consolidating before it launched. Zone 3 is the air pocket above highs, the space where there's less chart memory and more mechanical flow. In that air pocket, price can travel farther than your intuition thinks is rational, but that's not the part that matters. The part that matters is what price does when it returns to the launch area. Does it bounce with conviction, or does it slice through like it never mattered? That answer determines whether we're in scenario 1 or scenario 2. Scenario 1 is the controlled pullback and retest. In this scenario, silver pulls back into that breakout zone, volatility stays high, but it becomes more two-sided, front spreads stay relatively supported, and dips get absorbed rather than cascading. You might see scary red candles, but you also see quick recoveries. That's the market rebuilding a base. That's healthy. That sets up the next leg without exhausting participants. The confirmation for scenario 1 is simple. Price respects the breakout zone on a closing basis, the curve doesn't collapse, and the market doesn't show signs of panic liquidation across correlated assets. The invalidation is also simple. Sustained trade back into the prior base with structure breaking and the curve easing meaningfully. If that happens, it doesn't mean silver is dead. It means the timing changed. And timing is everything when your window is 72 hours. Scenario 2 is continuation squeeze and gap risk. In this scenario, pullbacks are shallow, recoveries are violent, and the market spends less time giving you nice entries. You see overnight gaps, you see intraday air pockets, you see that unsettling feeling of price running without you and then snapping back just enough to punish chasers. The confirmation for scenario 2 is not just price going up, it's price going up with stress signals intact, firm front spreads, persistent bid in physical channels, and behavior that suggests participants are paying for immediacy. In this scenario, risk management is not optional, because even if you're right, the tape will try to break you, and that's where the real pressure starts. Now, who is on the other side of this? This is the part the skeptics care about, and rightly so. In every market, there are players whose incentives prefer calm. Calm reduces hedging costs. Calm reduces margin. Calm reduces the chance of liquidity accidents. Some participants, banks, dealers, industrial hedgers, prefer orderly markets because order is cheap. Others, momentum funds, macro allocators, panic buyers, don't care about order when they're chasing exposure or protection. When a market is calm, those forces coexist. When a market is stressed, they collide. Dealers widen spreads and reduce size. Funds push size because their models say buy. Industrial buyers hesitate until they can't. Shorts manage risk until risk manages them. That collision is what creates violent price discovery, not a secret cabal, a collision of incentives under constraint. Now add supply chain reality, because this is where silver differs from a pure monetary asset. Silver is produced from a mix of primary silver mines and as a byproduct of other mining, lead, zinc, copper. That means supply can be stubborn in the short run. Even if price spikes, you don't instantly get more silver. You need time, capex, permitting, and throughput. Refining is a bottleneck. Logistics is a bottleneck. You can have silver in the world, but not in the right form, in the right place, at the right time. That is why physical tightness often shows up as premiums and delays rather than a neat inventory collapse. And when industrial demand is in the picture, electronics, solar, medical, specialized applications, demand doesn't always politely step aside because speculators want to play a chart. Sometimes industrial procurement gets defensive. They lock supply because the cost of not having silver is higher than paying up. That's when supply chain vetoes the paper market, not with a press release, with behavior. Because if this one level breaks, the math changes. Procurement doesn't buy dips emotionally. Procurement buys to avoid production disruption. That demand is sticky. So what do you watch right now, today, this week, in the next 72 hours? You watch the lie detector. First, watch the curve and front spreads. You don't need a PhD. You just need to notice whether the market is paying up for near-term delivery relative to later delivery. If the front stays firm while price chops, stress is still present. If the front relaxes sharply, stress is venting. Second, watch the quality of pullbacks. Are pullbacks being bought quickly in the breakout zone, or are they cascading through it? Third, watch correlated signals, gold behavior, dollar behavior, and rates behavior. If safe haven demand remains intense and the dollar weakens into uncertainty, that supports the metal complex. If the macro tape suddenly calms and yields spike, metals can get hit even if the longer-term thesis remains intact. Fourth, watch physical symptoms, premiums, delays, and any sign that retail availability is tightening again after a price spike. Fifth, watch the behavioral tape. Are people dismissing the move as just mania, or are they quietly scrambling to get exposure because they feel underpositioned? The second is the one that creates the second leg, and that's where the real pressure starts. Now let's do a quick, clean math moment so you understand why small dislocations become big moves in silver. Suppose the tradable float, metal that can realistically be mobilized without friction in a short window, is only a small fraction of total held metal. That's normal. Most metal is owned by someone who isn't selling because price is exciting. In that environment, if incremental demand arrives, through ETF creation, through industrial procurement, through hedging, through short covering, you're not competing for the entire stock. You're competing for the marginal available ounces. And marginal ounces set price. If marginal availability shrinks even a little, the price required to entice selling rises a lot. That's convexity. That's why silver can move 5% like it nests nothing, and then move another 5% like it's still nothing. It's not because the world changed twice in 2 days. It's because the market is repricing the marginal cost of immediacy under constraint. But that's not the part that matters. The part that matters is how you respond as a retail investor who wants logic, not adrenaline. Here's how volatility will try to use you. It will show you a massive green day and then punish you with an immediate pullback so you associate buying with pain. Then it will show you a scary red day and then rip higher so you associate selling with regret. This is how markets extract liquidity from humans. The antidote is process. You decide your exposure in tiers. You size so that a violent swing doesn't force you to act. You respect that price can whip around even if the thesis is correct. And you separate, I want to be right, from outsized, I want to make a good decision. The market doesn't pay you for being right in public. It pays you for managing risk in private. Now we get to the concrete payoff, what comes next over the next week or two, and what matters in the next 72 hours. If silver holds the breakout zone and the curve remains stressed, the path of least resistance can remain higher, and the market can attempt to revisit the recent highs quickly. In that continuation scenario, the next upside is not about calling a magical number. It's about recognizing that once a market is in air pocket territory, it can overshoot until it finds a new set of sellers or until liquidity returns. So you should expect sharp up moves and equally sharp snapbacks. That's normal. It's not a sign you're wrong. It's a sign the market is stressed. The key is whether the stress signals fade. If they don't, the market can keep climbing in bursts. If they do, the market can stall even while the price remains elevated. If silver fails the breakout zone and spends time back in the prior base, the thesis isn't dead. It just means the market needed to cool the structure. It means some of the mechanical demand was satisfied, some positioning was reset, and the next leg might require a new catalyst or calmer macro tape. In that scenario, the playbook shifts. Instead of expecting immediate continuation, you expect range behavior, and you let the market show you when it's ready. because the worst thing you can do in silver is fall in love with a timestamp. You don't get paid for predicting the day, you get paid for reading the structure. And that's where the real pressure starts. So here's the next week checklist, spoken like a market bulletin, not a bedtime story. 1. Does silver stay above the launch zone on closes, even if it dips intraday? 2. Do front spreads and near-term pricing remain firm relative to later months? 3. Do physical symptoms, premiums, delays, availability stay elevated or re-accelerate after pullbacks? 4. Does gold remain bid as a safe haven proxy? And does the dollar remain under pressure, supporting the metal complex? 5. Do moves happen in a way consistent with hedging feedback? Fast ramps into key zones, shallow pullbacks, and sudden gaps? If you see that cluster, it's not just emotion, it's math and constraint. If you see the cluster fade, curve relaxes, physical symptoms cool, pullbacks deepen, then you treat the move as a completed impulse that needs time. That's not bearish, that's disciplined. Now, a subtle but crucial point for the skeptics who demand mechanism. Suppression doesn't just need to be a cartoon villain to be real as an incentive. In every market, there are incentives to damp volatility because volatility is expensive for balance sheets. So you can have behavior that looks like resistance, selling into rallies, capping moves, pushing price back into ranges, simply because participants are managing risk and defending levels where their books are sensitive. That doesn't mean someone controls the market. It means someone has exposure, and exposure creates behavior. In a stressed market, that behavior can work until it can't. Because if the physical and structural signals keep tightening, the cost of defending becomes higher than the cost of letting price go. That's when the market can't unsee it. That's when the spread becomes louder than the headline. And that brings us back to the one metric everyone must watch, especially in the next 72 hours. The stress gauge is not the quote, it's the curve, how much the market is paying for immediacy. When that gauge stays elevated, it tells you that participants who need metal now are still competing, that the system is still under strain, and that the tape can still gap. When that gauge relaxes, it tells you the urgency is fading, and the market can shift from squeeze behavior into digestion. Either outcome is tradable and investable, depending on your horizon. The mistake is pretending you can trade a stressed market with unstressed emotions. So here's the calm, non-begging CTA, because the right community for a market like this isn't the to the moon crowd. It's the crowd that respects mechanisms. If you are the kind of investor who DEA rather understand the plumbing than worship the headline, stick around and keep your eyes on the checklist. Drop your observations, curve behavior, physical premiums, and the way price reacts at the breakout zone, because the fastest way to get better in a market like silver is to compare notes with people who care about structure, not hype. And above all, remember this. You can be directionally right and still get chopped to pieces if you resized wrong or emotionally reactive. Price can whip around violently even if the bigger move is still building. Trend signal is the structure, noise is the shakeout. Respect both, and you stop being the liquidity. And if the next 72 hours do what stressed markets often do, thin liquidity, forced flows, hedging feedback, then the move won't feel logical in the moment. It will feel unfair. And that's usually how real moves begin. It does that nasty thing where it runs through levels, pauses just long enough to bait you, and then it launches again. Because participants aren't trading a chart. They were responding to the risk of being short the thing that can got to be replaced quickly. And silver is uniquely positioned for this kind of behavior because it's a hybrid. It's part monetary metal and part industrial input. And those two identities behave very differently under stress. That's where the real pressure starts. Now let's talk about paper versus physical without falling into cartoon conspiracies, because you don't need conspiracies to explain incentives. Futures markets exist to centralize price discovery and transfer risk. That's normal. That's healthy. But futures markets can keep trading even when physical conditions are tightening because most futures positions never go to delivery. So the futures price can look like a smooth story while physical tightness expresses itself elsewhere, through spreads, through lease rates, through premiums, through the willingness of participants to part with deliverable bars, through how expensive it is to move metal from one region to another, and through the subtle but powerful signal of the curve. Think of it like this. The futures quote is the public conversation. The curve and the spreads are the private group chat where people tell the truth. If the market is calm, those two align. If the market is stressed, they diverge. And if this one metric breaks, the math changes. The curve matters because it tells you what the market is paying you to do. In a normal, well-supplied market, you usually see contango. The future price is higher than the near price, reflecting storage, financing, insurance, and the convenience of time. That's the market saying, we're not desperate for the metal today, we can wait. In a stressed market, you can see backwardation. The near price is high relative to the future. That's the market saying, I will pay you to give me the metal now. That is not a vibe. That is a scarcity signal. And when that scarcity signal shows up, it forces behavior. It pulls inventory forward. It discourages carrying metal for later. It pressures shorts who assumed they could roll cheaply. It can turn a simple hedged position into a problem because the roll yield goes against you and the physical sourcing becomes more expensive. That's not the part that matters. The part that matters is what happens when the curve starts telling you that time is no longer cheap. Now layer in inventories, because this is where people get fooled by big numbers. You will hear people say there is plenty of silver in vaults, as if the gross tonnage solves the problem. But not all inventory is equal. Some inventory is deliverable into a contract framework. Some inventory is simply stored, owned, and not available at the price you want. Some inventory is spoken for by industrial supply chains, leasing arrangements, or other claims that make it effectively off the market. And in precious metals, that distinction, deliverable versus non-deliverable, matters more than almost anything. Because when delivery risk rises, the market doesn't care how big the warehouse is. It cares how much can actually show up when someone calls the bluff. The next detail is what flips the whole setup. When a market goes from ample to tight, it rarely happens because the world ran out of metal overnight. It happens because the tradable float shrinks at the margin, and the margin is where price is discovered. So ask the right question, not how much silver exists, but how much silver is willing to move at this price in this window into deliverable channels. That's where stress reveals itself. That's why you can have a market that looks fine on paper and yet behaves like it's running out. Because what drives spikes is not total supply. It's available supply at the point of need. And in the next 72 hours, point of need becomes very real as participants roll, rebalance, and hedge. Now stack the proof the way a skeptic should. First proof point, the chart structure itself. When silver is in a regime where it's printing new highs and doing it with speed, it often means resistance above is thin. That's not magic, that's market memory. Above prior highs, there are fewer trapped longs waiting to sell to get back to even, and there are fewer obvious supply levels where sellers are comfortable leaning. That can create blue sky behavior where price moves farther than rational people think it should, simply because the market doesn't have a thick wall of natural sellers. In those regimes, what matters most is the breakout zone in the first retest. If silver can hold the breakout zone on a pullback, call it that area where the move truly accelerated, then dips become invitations for hedgers and momentum flows to re-engage.